So what is quantitative tightening? Since 2008, we've been in a period of quantitative easing where the Federal Reserve is cutting interest rates, meaning the cost of doing business, the cost of servicing debt is going to be a lot cheaper. And they've also been buying assets, buying treasuries, buying mortgage-backed securities to prop up asset prices in the United States. This has a stimulating effect on the economy because it's pumping a lot of new money, pumping a lot of cheap money into the system that companies can use to hire people, reinvest in their business, and expand the economy. If you're a new investor, you haven't likely been investing in a period of quantitative tightening, which basically is just the opposite of that, where they're going to raise interest rates, making the cost of business and the cost of servicing your debt quite a bit higher. And they're also going to be selling assets off of the Federal Reserve balance sheet, meaning they're going to be pulling money out of the system, which has a negative effect on asset prices, but hopefully will ultimately have a deflationary effect on consumer prices. If you're invested in stocks, bonds, real estate, cryptocurrency, make sure you're diversified because it's likely going to be a pretty rough road ahead for the foreseeable future until the Federal Reserve ultimately pivots back to a quantitative easing in a cheap money environment. The Federal Reserve is also going to be trying to do a balancing act between tightening to the extent that tames inflation, but also to the extent where it doesn't cause a recession and cause companies that have a lot of debt or have used debt irresponsibly to go bankrupt or be insolvent. We're going to be talking a lot more about quantitative tightening on the podcast this week, so make sure you tune in and have a great week, everybody.